start recording. Okay, so now we will be doing now we'll get into the first week's lecture. Okay, now here you notice there are 92 slides, so I'm not going to go into 90. I'm not going to spend enough time on each, because some of the slides is just information. If there is just information, I'm not going to read it out and I will just tell you. There's a lot of stuff that you have to memorize in this module, but it's just short-term memory. It just needs to last you till the end of the exam. And later on, you just have to know how to find the information, right? I think a famous, I think it was Confucius who said this, that either we know something or we know where we can find the information on it, okay? So certain things like information, like it's just, okay, what is the tax filing date and all that? This is not something you really want to keep long-term in your brain. You should know where to find it. If you need to find that information, then you should know where to find it. Okay, so that's the thing. So, but here at least certain things you need to keep. Some of the things which are, actually I think it's a little bit stupid to expect people to memorize these things, but this is how the exam is, okay? So we have to deal with it. So it's just you have to memorize all the tax filing dates, what are the payment dates for taxes, okay? What is the tax year for companies, the tax year for individuals? These are actually what I think to be stupid things, but we have to memorize it for the exam, okay? So, because there's no value addition here, there's no logic or thinking involved. It's just a rule, okay? So, anyway, so what we'll have this, so let's have so I'm going to skip over a lot of slides, and I will just point out, that's why it's very important to pay attention in class. And if you have not attended the class, then you should watch the lecture recording, because from the lecture recording you can see where I'm putting emphasis or where I'm instructing you to memorize this. Okay, so if there's some information, I will just tell you, you have to memorize this, and then I'm not going to spend time on it because it's just information. All right, so the introduction part, we are not going to spend too much time. Okay, sources of law we have already seen, and there's a very similar to that. Okay, so we have different types of tax. We'll be dealing with all these. We have certain classes on each of these categories. Okay. Now, so the first thing that we are learning is, but at the same time, even though this is like a very difficult module because the volume of material is just too much for the amount of time, okay? It's only difficult because of that. Otherwise, it's just a bunch of rules. Just a bunch of rules, and then you apply the rules to solve the problems. So it's almost like a computer-like work, okay? So, but human beings have to do it, and there's a lot of stuff to master in a limited time. Okay, now what was I saying? Okay, so let me just go to the thing here. Okay, indirect and direct taxes. So what I was saying is actually, why are we even discussing this? Because this is not going to be a question as such. But what I was saying is that, okay, while our main objective is to do well in the exam, but at the same time, along the way also we want to learn a little bit as well. From every module we should get some learning which we can retain. Because remember, at the end of the day, when you're graduating after 4 years, you should be already a very polished and very well-rounded accountant. And you should have retained all the things that you have learned. If you don't retain the learning, then there's no point, okay? You're just a person with a degree hanging around your neck. You don't know anything because you forgot everything. So you have to retain, so we have to learn certain things as well. Okay, so you have to be a thinking individual, even though this is mostly a memorization and practice module, just like kind of maths actually. But still we want to be able to learn something along the way, okay? Because you always want to have that focus of you as an accountant. That means you understand economics, you understand finance, you understand law, and you understand accounting, and you're working on the problems of the real world, okay? In the real world, you don't have problems that come only in accounting format, or only in finance format or law format. Everything is mixed up. Okay, so that's why we need to learn also along the way. So that's why indirect, direct taxes you should know, okay? Which is, so along the way here, I also introduced this concept of progressive and regressive, okay? Which is not really in the syllabus, okay? This is slide number 4. So some are direct taxes and some are indirect taxes, okay? So we'll see what are direct, indirect, and then later on I'll talk to you about regressive and progressive, okay? Some are direct taxes and some are direct taxes. Basically means that you can identify it with an entity when you're levying it, okay? So this is Hazel's income. Hazel's income for the year is so much, and so Hazel has to pay so much tax. So we can identify it with the person's income, or we can say this is, let's say, PetroChina's income. So although here we call it corporation tax in the UK, but actually it's the income of a corporation, right? In the UK we have this, this corporation tax. It's actually the income tax per company. They just don't have good nomenclature in the UK, so they call it corporation tax. Actually, it's the same as income tax. It's the income of a company on which you're paying tax. So these are direct taxes, because why? This will be paid by, say, PetroChina subsidiary in the UK. So PetroChina has a subsidiary in the UK. This is they are going to pay corporation tax. That's a direct tax, because just like Hazel, we can identify this as, okay, this is PetroChina's income, and that's why they're paying interest on that, income tax on that. So direct taxes are those which are levied on entities that can be identified, like either a person, like a natural person, using our language from last semester, a natural person, or a artificial person. Remember these terms, don't forget these terms, okay? This is your learning from last semester. PetroChina subsidiary in the UK is an artificial person, okay? Just like Daimler versus Continental, remember we did that case, okay, in in corporate personality, Daimler versus Continental Tire and Rubber, okay, on lifting the corporate veil. We did that case, right? So those are all artificial persons, the companies. All right. So these are the direct taxes which you can identify. So what is the feature? It's actually not it's explained here, but this part is not mentioned, okay? That these can be, what is the difference between direct taxes, okay? Why did I use the word entities? I did not say people, okay? Or I can say entities or legal persons. Why did I say legal persons and not just persons? Because it's not limited to individuals. It also extends to companies, okay? So that's why when I say legal person, that means I mean both companies and individuals, because companies are artificial legal persons. Remember that, okay? So you have to also use your language like this, okay? So they can be identified with specific entities or legal persons at time, I'm not using the word the, we should use the word the, at time of levy and, okay? So basically this is the idea here, okay, at the time of the levy. In the case of direct taxes, you can identify it, and indirect taxes, you can't identify it, okay? So indirect taxes at the time of okay, or I'm not very well worded definition, but at least gives you the real distinction between direct and indirect taxes. So direct taxes is basically we find out what your income is, and then we charge you income tax on that, okay? That's a direct tax, because we first found out what your income is, and then we levied the tax. But there is an indirect tax, which is, you will find that this one here, okay, the main direct taxes, indirect taxes are, they're already given to you. I was going to ask you as a question. So indirect taxes are things like VAT, it's called VAT, sometimes called VAT. VAT stands for value added tax, okay? So you can find out if China has value added tax. So China will definitely have some kind of sales tax. It's like a sales tax. So these sales taxes are indirect taxes, because sales taxes are levied on products, okay? So even like excise duties, etc., customs duties, these are levied on products, okay? So if you sell an iPhone, there'll be maybe some sales tax of 5% or something like that, okay? So if you put a sales tax of 5% on any electronic items, that means that that's an indirect tax. Because why? because we can't identify that 5% as being connected to some individual or anything. It's just it is connected to a product or service. Okay, so you can think about it this way, that it can be identified with specific entities or legal persons, and the indirect taxes are actually identified with products or services. Okay, so that I'll write that down later on, but this is basically the idea. Okay, so some of the stuff I won't write because the video is recorded. So that's the main difference between direct and indirect, that it can be basically, in the case if you have a 5% tax on iPhones, that's a sales tax. So that's not identified with the individual. Whoever buys that iPhone, even if a low income individual who will otherwise not pay income tax, okay, maybe his income is too low or he has no income, even when that person buys an iPhone, he has to pay 5%. Okay, even if a billionaire buys an iPhone, he has to also pay 5%. So it's not a function of the individual's income. The sales tax is not a function of the individual entity's level of income. Do you understand? Okay, so that's basically what it is. So it's indirect taxes. Okay, I got a good definition here. Okay, again, now this is the point of so we can say it is levied on products and services, and the rate is not a function of any legal person's level of income. Okay, as we will see very soon, that tax rates can differ for level of income. So we have a 5-minute break. Okay, now we have a good definition of direct versus indirect. So indirect is on products and services. So take a break, 5 minutes. Okay, so we were talking about, okay, so we spent, now this is not going to come in the exam, I guess, but it's very important for you to understand conceptually. So indirect taxes are normally levied on products and services, and the important thing is that the rate of the indirect tax is, this is the real distinction, is not a function of your level of income. So when a billionaire buys an iPhone, he has to pay 5%, let's say that's the sales tax. When a person with a homeless person buys an iPhone, he also has to pay 5%. Okay, so they don't care what your level of income is. Whereas income tax, as you will see, direct taxes, which is income tax or corporation tax, the rate is a function of the level of income. Usually, most of the cases, as there is one exception, but most of the time it is a function of level of income. Then I will quickly teach you something else about, and so I'm not going to spend time writing on these things because they're outside the syllabus, but it's important for you to know these concepts. Now taxes, okay, we can also, while discussing this, we can also talk about regressive and progressive taxes, okay, and flat rate taxes. So there are 3 types of tax systems. There's either a regressive system, a progressive system, or a flat rate system. So what I told you is that the level of income, the tax is a function of level of income. That is generally true, except for the flat taxes where everybody pays the same tax. But that statement is still true, that it's a function of the level of income. It's just that they're levying flat rates for everybody, for across the board. But another point is the regressive versus progressive. Let's learn that. So let me just open the tax tables here quickly, if I can. Yeah. Let me just here. If I can stack the tables. Yeah, I just created it actually. Right. I'm just trying to show you what is. I'm showing you the UK tax tables. This will be part of your folder. I will upload it. But I'm also showing you what is meant by a progressive tax system. This is what we have in most countries. Okay, you see this? You see the bands of tax. Now, these are your UK tax tables. It's also an introduction to the UK tax tables. This will be given to you in every exam, and so I'll share this with you as well on this year for this year's tax table. And so one of the things, you need to be familiar with the tax table, because anything that's in the tax table you don't need to memorize, because this will come to you in every exam, class test, final exam. It will be given to you. So you do not need to memorize whatever is in the tax table. So make sure you know exactly what is in the tax table to reduce the load on your brain. Now let me explain what is a progressive tax system, this is called a progressive tax system. Most countries have this. China also has this kind of system, where if you make a certain level of income, they tax you at the lowest rate, from the bottom up to 37. This is the lowest rate. If your income is between this one and this one, then you pay 40% on the income between those two levels, okay? And then over this you pay 45% if your income is over this, okay? So this is called a progressive tax system, where it's progressing. The tax rate is increasing as your income level increases, okay? So the threshold will be different. So in China, the figures may not be like this. There'll be some other figure, and these rates also will be different. Actually, China income tax is lower than the UK, which is very funny, because China is a communist country which should have a higher rate of tax, but the UK is a capitalist country which has a higher rate of tax than China, which is quite funny actually. Anyway, so that's how it is, because the UK is, they're not very pro-business actually. So that's a problem, sorry. Yeah, okay, so this is a progressive system. So opposite of progressive is regressive. Let me go to the notes again. Opposite of progressive is regressive. Very few countries have this system, but theoretically we should be aware of it. The opposite of progressive is regressive. That means the more you earn, the less rate of tax you pay. Okay, so all we have to do is to make a regressive system. Is here we have 20 here, then we have 15 here, and then we have 10 here. That becomes a regressive tax system. As your income level is rising, your tax rate is falling. You should theoretically be aware of this concept. Okay, hardly any country has it actually. Then there's a flat rate of tax, which some countries have. Okay, which is, let's say, 15%. Okay, so even this slab is 15%. This slab is 15%. This slab is 15%. It's all the same. Okay, that's called a flat rate of tax. Okay, that also very few countries have. Most countries have this kind of progressive tax system. Okay, so anyway, quick note on that, a little bit of conceptual discussion. We spent a little bit of time, but as I said, we can spend a little bit of time also in improving our knowledge, because that's also one of the goals in the module. First goal is to do well in the exams, but the second goal is also to pick up some important knowledge along the way. All right, indirect taxes. Now you can see, okay, mostly on, you can see value-added tax is all on goods and services. It's on basically all your sales tax, etc. It's all service tax, all those things. Any kind of, your barber cuts your hair, there is a bill, and then there's a tax on that because he's cutting your hair. That's a service. So, okay, we don't care about who's administering it actually as such. Sources of tax law, which basically, as you can see, mostly it's statute law and case law decisions taken by judges. We already saw that in law earlier. We didn't spend too much time on statute law because my goal was really to teach you a pure common law kind of module. So we focused mainly on the case law. Then EU directives, these are actually just a type of statute law. EU directives and regulations, these are just a type of statute law produced by the by the EU Parliament. So it really should go under this one. It's statute law. But anyway, we don't worry about it. Tax years. Now we start to get worried about things because we have to memorize certain things. Yeah, so there is a tax year derived. It's basically the period of income, the period over which your income or activities are going to be taxed. That's your tax year. Okay, now you have to memorize this. Okay, so I'm not going to read it out, but here's a memorization. Okay, memorize topic, page 9. I can actually just do one thing here. Maybe I can, every time we have memorize. I'll put it right on top for this topic. Memorize. Which one is this? Slide 9. Memorize. 9. I'm not even going to write slide. Memorize slides. Okay, that means that information there needs to be memorized. So I'm putting it in your notes so that you don't have to specially note it. You will have access to this note. So as we come to the slides, I will tell you memorize. Okay? So I'm not going to spend time talking about it because you have to memorize it. Okay, memorize. Yeah, memorize. Tax year for companies, tax year for individuals. We don't need to worry about this, who is carrying out HMRC. This you can just read. Some stuff, because we don't have that much time, there are 92 slides. So I'm just going to skip over some slides which you can just read, just information for you to read. There's no point in my wasting time telling you all this, okay? This is not really that important. Okay, so this is called self-assessment. Okay, they may use language like this, so you need to be aware of that. So these terms you need to be aware of. I'll spend a little bit of time on this. So there is something called deduction at source. Okay, so some types of income is deducted at source. So like when Duffy is paying my salary, they're already deducting the tax at source. That deduction at source means that the source of my income is Duffy. Now Duffy is deducting my, so that's deduction at source means that the source of my income itself is deducting at that source itself, my tax liability is being deducted, and they're paying it directly to the tax authorities here. Okay, so that's what is meant by deduction at source. Source of the income. The source means source of the income. Okay, and this is actually pay as you earn. P-A-Y-E is pay as you earn, and this also it's a type of deduction at source. Deduction at source is a general concept that wherever the income is being generated, at that source itself, before the income is paid to the individual or entity, then at the source itself, the tax liability is determined and deducted and paid directly to the tax authority. That's what deduction at source is. So pay as you earn is one type. So this is your employment income. So what is happening to me here in Duffy, that's a type of pay as you earn. Okay, as I'm earning every month, deduction is already happening and Duffy is sending the tax amount to the tax authorities. That's pay as you earn. So you should know about this because you have some problems in the questions. They will say that this person earned so much money, and pay as you earn deduction was so much. That means that later on when you and the question might ask how much tax does he have to pay, how much incremental tax does he have to pay. There you'll have to take out the pay as you earn. So if he has to pay like say $1 million in tax, but there is already 300,000 of pay as you earn deducted, that means he has to finally pay only 700,000, because out of the 1 million, 300,000 was already deducted as part of pay as you earn. Do you understand? Okay, so you have to take out the pay as you earn. That's why you need to know what pay, we'll call it pay or something for short. Right, so here, this is the main thing here to understand. The concept of deduction at source. Deduction at source and pay as you earn is a type, it's a language used in the UK. Okay, other countries may use some different language, but the concept of deduction at source is common across many countries. Okay, the system of deducting tax at source. So tax deduction at source is a general concept that you can find in different countries. In the UK, one of these types of deduction is called pay as you earn for employment income, okay, for employees. Okay, memorize. Okay, we don't need to waste time discussing it because you have to memorize it. Due dates of payment, memorize. I'm not even spending time on it because you can read it later and because this is just information. Okay. So you should remember this, POA, because the question might just say POA. It may not say payment on account. And payment on account is also like a term of art. So you need to understand what payment on account means, right? So you need to, so when you memorize, you have to memorize this also. What does payment on account mean? And this is known as a balancing payment. The last one is known as a balancing payment. So the question might also ask, what is the balancing payment? So you should know these terms, right? So when I say memorize means you have to memorize all the relevant items from here. Yeah? Okay? Are you okay with this concept where if there's something to be memorized, I'm not spending time on it, reading it out. What's the point? I'm just telling you what has to be memorized. These are just dates, and then you just memorize it. Is that okay? Yeah? It makes sense? Because we have very limited time, and I need to spend time on explaining concepts like direct, indirect, although it's not part of your syllabus. But I think it's very important for you to know as an accountant. And where else are you going to learn it? Maybe nobody else will teach you it. There's no real reason to teach you this basic stuff. But these basic distinctions, conceptually, that's what I want to spend time on teaching you how to do, and how to solve the problems and stuff. Okay, notification of chargeability. Probably not a very big deal, but probably I think what I'll do is I'll create 2 memorization lists. Okay, important to memorize. Okay, important memorized slides. Okay, and so I'll create 2 categories of memorized slides, and then I'll have another one which is maybe not so important. Okay, so I will say, I wouldn't call it optional. I'll tell you what I'll call it. I'll call it do if you can. Okay, this is like, okay, nice to have. Okay, do if you can. This one you have to do. Okay, important ones you have to do, and this one is do as you can. So I will put this into do as you can. Okay, this notification of chargeability bit, if it do is do if you can. Okay, this 15, number 15. Right, so it's basically, the purpose of this is to make sure that HMRC, we will be using that acronym all the time in the UK tax system. HMRC is simply Her Majesty, right now it's His Majesty because the King is Charles. When his mother was the Queen, so we would call it Her Majesty's Revenue and Customs. And now that Charles is King, we'll call it His Majesty's Revenue and Customs. So HMRC stands for His or Her Majesty's Revenue and Customs. So Revenue and Customs means they are in charge of collecting all the direct and indirect taxes. It's a UK tax authority, basically. So when you see famous tax cases, and there's some very interesting tax cases, you will see that so-and-so Duke of Westminster versus HMRC. That means that Duke of Westminster was fighting a case against the tax authority. Okay, so most of these will be called HMRC. Right. Record keeping. This one you have to, I think this will go into the important, because we can have questions on this. Yeah, better keep it as compulsory memorize. Okay, so 16 also goes into compulsory memorize. Okay, so these are record keeping requirements. So this will also be a feature which is there in most countries, except that the rules will be different. In most countries there will be some kind of, this is connected to what we call in law the law of limitation. Okay, law of limitation, we didn't have time to study it, but you should be aware of this concept. Law of limitation exists in most of the common law countries, which is basically all the former British colonies, where you'll find that there is some kind of, usually it's around 6 years. So if something happens, like if maybe I feel that we did a transaction and you cheated me on the deal or something, so maybe that transaction happened like 4 or 5 years ago. Whenever I felt that the offense happened, within 6 years I have to file a suit. If I don't file a suit within 6 years, if I have a grievance, then I no longer can get the remedy from the legal system because the legal system wants to put a limit on certain things. So I still have the right. Like if you took something which belonged to me, the property, that right still belongs to me. So if I can get that property back again, I can keep it. It's still my property. I have the right, but I lose the remedy. There's a distinction in law we make between a right and a remedy. You can have the right, okay, but you don't have the remedy, okay. So because after 6 years or so, typically it's mostly 6 years. So this is a concept of limitation, okay. Just like in tort law, if you remember, we studied the concept of sometimes there may be a tort, but if it's a tort of negligence and there is no actual harm, there's no actual damage, there is no damnum, then you have no remedy. But you have a right in the sense that conceptual, your right was violated, there was a tort, but because the rules that they have for negligence lawsuits is no damage, somebody violated your right, no damage, so no remedy, okay, no court action possible. So that's the concept. So tax record keeping is connected to the idea, so I'm just giving you some conceptual understanding of the tax system so that you also have some kind of a good qualitative understanding. It's not that we're just skipping through pages saying memorize, because then it becomes quite mechanical. So you have to understand the reasons for certain rules and what is the legal foundation of that. So there's the concept of law of limitation, which you will find in many common law countries. So record keeping is connected to that. So after a certain period of time, the tax authorities can no longer sue you. Even if they feel that you concealed your income maybe 15 years ago, so if the law of limitation is 6 years, even if they suddenly find out that this person concealed his income 15 years ago, it's too bad. They can't sue you for it, okay? It's already gone now, beyond the period of... So the record-keeping rules are generally connected to the law of limitation in the country's tax code. So they may inquire, these are procedural matters. They will ask, okay, assessments. You can appeal against it. This you can just read. So whenever I'm skipping us through a slide, you still have to read all the slides, okay? All the slides that are given to you, you still have to read them. Obviously, the ones which I highlight as memorize, those are very important. You have to memorize those. And everything that is important anyway, I'll be emphasizing. But you still generally should read all the slides. Is that clear? Just because I'm skipping through it, I'm not spending time on procedure on appeal, you still should, because it's a part of our slide material, you should still read it, okay? Now, here's another concept. We will deal with it in more detail in lecture number 2, but I'll just give you some brief idea. You should know these terms, and they are in your notes as well. Okay, now I have already mentioned to you about stocks and flows. Again, this is outside the syllabus, so I'm not going to spend time on it. Did I mention to you last semester about stocks and flows? Yeah, okay, so I've already taught you this concept. Okay. Right, slide 19. Slide 19, okay? Tax evasion and tax avoidance. Okay? Which one is legal? Do you know? Tax evasion and tax avoidance. Which one is legal? Avoidance. Very good. Okay. So tax avoidance is legal. Tax evasion is not legal. Okay. Is illegal. Okay. So basically here, okay. So what we are talking about is here I'm trying to define the Westminster principle. This is called the Westminster principle. Okay. So there's a link here. I'll give you some links to tax cases if you want to read them. The tax is a very interesting area of practice. If you're going to be an accountant, you can specialize. One of the areas in which you can specialize is tax law. If you find it interesting, I'll give you some links to tax cases. Okay. So here's a list which here's a document reading which obviously opens in China as well. So you can read about it. You should read about it. Okay, in your spare time. It's not part of your syllabus. Okay. But you can mention it in one of your questions in topic 2. So it's an important thing to be aware of, the Westminster principle. Okay. So this is basically the same principle. So what we are saying is tax evasion is concealment of income. So if I have income from some source and I don't tell anyone about it, don't tell the tax authorities, that's called tax evasion. I'm concealing my income. Okay. because I should have paid some tax on that income, so I don't want to pay the tax, so I conceal that income. That's an example of tax evasion. Okay? Or you understate your income. Maybe you have some cash income, and you are running a shop and you have some cash income, and you don't disclose the cash income. Okay? But you should be paying tax on sales tax on your and even income tax on the profits on that cash sales, but you don't disclose it. So those are all examples of tax evasion, and that is illegal. Okay? What is not illegal is this line here, that taxpayers are entitled to organize their financial affairs to minimize the tax burden. Okay? This is called broadly, I mean, it's not officially called like that, but it's actually, there is a name for this in the law effectively, which is called the Westminster Principle. It comes from a very famous case, and you can read about it as I open that case. Okay, I've already closed it now. Anyway, so Westminster Doctrine, you'll find it in a lot of other areas. You can see it's a tax term, but you can see it's come into the accounting terms. See, it's come into the accounting terms lexicon, because that's what I mean by saying that all these things like accounting, finance, tax, all these are all interconnected. They are not really separate subjects. And so tax, as I told you, is a very interesting area of practice for accountants. Okay, if you have a good understanding of tax law. Westminster Doctrine here. This is, as I told you. Okay, so this is basically, they have not mentioned it in the slides, but there is a name for this, so you should know about it. It's called the Westminster Principle or the Westminster Doctrine. It comes from a very famous case. See, that time it was called, Commissioners of Inland Revenue versus the Duke of Westminster. So the Duke of Westminster had some tax matters. These guys challenged it, the Commissioners of Inland Revenue. And anyway, you can read about it later. See, it's come in the accounting terms. It's actually a tax law matter. Okay. So as I told you, so one of the things you have to think about, what area you will practice in as an accountant when you graduate. So one of the areas is tax. Very fascinating area of practice. Okay, so anyway, you can do this. So I gave you the additional links. Okay, so and here I've given you some other examples. So tax evasion and tax avoidance, and we have an entire topic too on this. Okay, tax and ethics, very connected idea. So we will discuss it in more detail, and there will be a question in the exam on this topic. Always is a question. So you should pre-prepare the answer. Okay, so we will prepare, I will give you some guidance. We will try to pre-prepare a kind of, standard kind of answer. And then, of course, we don't know what the question will be, but we know it's going to be on this topic. So we know what kind of material we need to answer that question. So we will prepare a general type of, I won't give you the answer, but I'll give you some tips. And you should prepare a general answer so that based on what the actual question is, you can twist it here a little bit and then answer the question. But that's an easy set of marks to pick up, because you know exactly what you have to do, and there'll be I will give you some further guidance. Okay, so tax avoidance is legal, tax evasion is not legal. Okay, we got that. Okay, these are all terms that you should be familiar with. GAR. As an accountant now, you have to be familiar with all these things. GAR. Okay. GAR also you'll find in most countries tax. I'm sure in China also, if you look at China tax law. The other thing that you have to do as understood is, since you're studying in China as an accountant, even though you're studying UK taxation, wherever you come across certain terms like GAR and all that, it's your duty to check the rules for China. Because that's another thing that will be expected of you, okay, other than tech savvy and all that. As a young student today, you have to be tech savvy. Now you studied in China, so you should have some idea about the tax. You may not be a China qualified accountant, but you must have some idea about what the tax system is like in China, right? Like, do they have GAR in China, okay? I know that there are famous tax cases in China as well, because on international tax especially, there are lots of disputes that happen between companies and the tax authority, and how does the Chinese court rule on that. So you should know about these things. As a Chinese student, you are expected to be well versed about everything that's going on in China in your profession. You understand? So you have to do that. That's something you have to look out for. Okay. some general anti-abuse rule. We don't need to have too much knowledge of this, but you should know the term, and you should know the basic concepts which are discussed. MTD we don't have to worry about. Okay. Now, when I said we don't have to worry about means it's not that important, but you should still read it. You should have some exposure to it. Okay. We'll see if they do it. Okay, this is a split of chapters. You can make a list of the pages here. Okay, how it has shifted. Okay. Okay. Okay, now the income tax introduction, we'll see. Okay, so here remember Scottish and Welsh taxpayers, anyway, we don't need to worry about that. We are only concerned with England, okay? We're only concerned with English tax law because the UK is England's, Scotland, Wales, that's Great Britain, okay? So the UK system is, the UK is England, Scotland, United Kingdom of Great Britain and Northern Ireland. And Great Britain is England, Scotland, and Wales. Okay, and then inside that we have England. So we are only concerned with England actually, because the Scots have their own tax system, some variations. The Welsh also have slight differences. So we are only really concerned with England. You will have some Northern Ireland type of questions in the VAT section. We'll tell you how to deal with those. Now, this is important, the concept of residency in tax system. This is very important because you have to understand that this is really talking about the concept of residency. So just like we talked about source of income, so when you look at, say, international tax, there are two ways to do it. One is based on residency and one is based on source of income. So residency is an important concept in tax law. There are some changes recently in the UK. But basically, if depending on whether you're resident or non-resident taxpayer, you get different rates of tax usually, and certain types of income are not taxed. Now you can see that if you're not resident in the UK, you don't get taxed on their global income. Okay, you don't get taxed on their global income. This is also another funny thing. See, in the UK is one of the few countries, like the US also does that. The US doesn't do it to non-citizens, but the UK does it to non-citizens also. So if I'm working in the UK and if I'm a resident, I will become a resident in the UK if I'm working, I have to pay tax on my global income. Okay, this is very important, whether it's local income or global income. So whatever income I'm making anywhere in the world, I have to pay tax on it. Okay, so this is quite now, for instance, in China you don't have to do that. In China you pay tax only on your local income. Okay, so people who are foreigners who are resident in China, they only pay on their local income. So anyway, so this is basically you can see this concept of residency, and that if you're a resident you pay tax on your global income. If you're not resident, you pay on your local income only. Okay, various types of income. We will be looking at each of those: employment, property, trading, etc. So trading income is actually for self-employment. This is what we call trading income. So the terminology in UK tax is not very well designed, but it's what it is and we have to just live with it. And so it's actually basically trading income is in a self-employment income. Okay. Exempt income, you should know this. Okay, so this goes in memorize. This is must memorize. What is exempt income? So mainly it's ISAs, it's better to memorize. Okay, so very basically certain types of, so you should also know this term, exempt income. Exempt income means that it's just exempt from income tax. So there is a distinction between exempt income and income taxed at zero rates. They are two different things, okay? So the income that is taxed at zero rates is not exempt income. It is still taxable income, It just so happens that right now the rate on that is 0. Do you understand? Okay. So there is a difference between exempt income. So I should mention this as a note in our notes, and we are on slide 27. As a concept, as a concept, this is important. Slide 27. Okay, before we get to slide 27, I go to, it's after the DOTAS, I think. Yeah, so let me talk about slide 27. Okay. Let me try to use text to speech here, speech to text here. Writing takes too much time. Oh, okay. Exempt income is free of tax. It is not taxable. There are certain types of taxable income which are not exempt income, but which are just currently subject to 0 rates of tax. It is important to note that these are not examples of exempt income. These are 0 rate tax income at this point. Because this concept will also come up when we do VAT. Okay, so, whoops. Pause dictation. Okay, this is important. Okay. Why is this distinction important between exempt income and income that is subject to 0 rate of tax at the current point of time? Because in VAT also you'll come across this concept, so this should already be filed in your brain right now. Then in VAT you'll have certain types of supplies of VAT. VAT is value added tax, which is basically sales tax. So you'll have certain types of supplies which are considered exempt supplies. That means they are not subject to VAT at all. So that is like exempt income. That's the indirect tax equivalent of exempt income. Is this clear? And there'll be certain types of supplies in VAT which are subject to 0 rate of tax. Okay, so those are not exempt supplies, but they are taxable supplies on which the current rate of tax is 0. Is this clear? These are 0 rate of tax supplies. So we need to create this separate category in our mind and understand that exempt income and 0 rate of tax income, or income taxes subject to tax at 0 rate, are two different things. The second category is not exempt income. When we do, not that, but VAT. All right, okay, so little note here, so exempt income. Okay, now this is getting into pro formas. So another thing you will get marks for, okay, and in the exam and in the assignments, and you will actually lose marks if you don't use it, is you need to follow the pro formas. So we will give you pro formas. If you see, for instance, under your folder, in your folder there is a thing called pro formas. Pro forma means it's a format, basically. It's a standardized format, and so you're expected to do these kind of returns in these formats. That's all. You follow the format, don't create your own format. And so these are different types of pro formas for different types of things. Okay? So we can look at those when we get to those particular topics, but this is the point. This is showing you one of those pro forma types. Okay, so how to calculate income and what are some of the terms. Okay, so you have your gross incomes from various sources. Take out the tax relief, that gives you the net income. So these terms are important actually. Look at these terms, terms are important. So this I'm not even going to mention as memorize. It's understood that this is important because these are all pro formas. When you see something like this, it's a pro forma because you still have to go through the slides yourself, right? And when you go through the slides, you can see all this, and you can see this is like a pro forma, okay? And so you need to understand the pro forma here. And these terms are important. Net income, taxable income. So once you take out from the gross reliefs, from the gross income, you take out the tax reliefs, that's the net income. Let me just do the slide here actually. I think it's quite important. So let's make sure we understand all these terms, okay? Okay. Gross income from various sources. What do we have? What do we have? We have gross income from various sources, business profits, income from property, savings income, dividend income, whatever, different sources. That gives you the total, the gross income, okay? Gross income, you can say, you can call it total income, okay? Less tax reliefs, any tax reliefs that come. We haven't really seen any tax reliefs, but anyway, this is a concept. This equals net income. So this is important. Okay, so I'm referring to slide 28, so I don't need to write that NI is equal to net income because it is already written on slide 28. Okay, is that okay? Yeah? Okay, that's equal to net income. Less personal allowance, okay? So if I'm writing it here, that means that you need to understand, be clear about these terms. TI, because there will be certain types of definitions which will connect to these terms. So if the definition talks about TI, then you must make sure that you are calculating the TI and not the NI. Okay, so you have to be clear about these terms. What is NI? What is TI? PA is personal allowance. Okay, NI minus PA is TI. So here's an income tax computation that you can see that you have basic rate tax. So now we are talking about these slabs. Now one of the things some of the terminology that I did not use, these are the tax tables, okay? Now these are called slabs, okay? These are actually slabs, okay? So here, actually, if you see, now we can refer to this. So these are the slabs. So there are 3 tax slabs we need to worry about, okay? The basic rate tax slab, okay? This one, this is called the BRT. Now this is the, let me see here what it says. Yeah, see, already it's given here, BRT, basic rate tax on the first 37. That means it's the first slab, 0 to 37 or 38. Second is HRT, okay, which is on 38 to 125. That's HRT. And third one is ART on over 125, okay? So these are the slabs. Now, 0 to 38 is, I'm just going to write 38. So this one is actually, we should use the, now, I want to just introduce some terminology here. It's very difficult to get, okay, 1 minute. I'm just going to write it here. Okay, so we got that. Now this is which slide? This is slide number 29. Where did I go with slide number 29? Okay, now here there was this mention of tax reducers. Okay, so that goes on to slide 28 and 29, actually goes on to 29. So we can start from here and we'll continue. It's actually slide 29. Okay. Okay, slide 29 is tax reducers, tax credits. Okay, and here we can also talk about certain things, certain terms. Okay, so 0 to 37,700. Okay. Okay, so we use this terminology called slab. Slab requires two numbers. Okay, for a slab you need two numbers, or at least in the third one we don't really have an upper limit, but there's a concept of it's okay. The upper limit is infinity. Okay, so infinity is acceptable. So so BRT is the tax slab. So this 0 to 3700 is BRT tax slab. Okay, and I'm not writing the other ones. That means that if this is the BRT tax slab, that means that this one is the HRT tax slab. Is this clear? If that one is the BRT tax slab, where is BRT coming from? Because I'm referring you to slide number 29. This note, so the notes also become quite important in this subject, because a lot of important things are being given. The class notes, the lecture notes that I'm creating for you, they also become quite important because a lot of important clarifications are being given here. Okay, so important terms that we need to be clear about. In slide 29 we have, so this 0 to 37.7 is the BRT tax slab. How will you know what BRT is? Because I'm referring you to slide 29. So BRT means basic rate tax. Is this clear? It's okay? Clear? That means that this is the, what that also means is that this is the HRT tax slab. This one. This one is the second one is the HRT tax slab. Yes? What is HRT? You know from slide 29 is higher rate tax. Clear? Okay. Now, then what? This is the ART tax slab. The upper limit is infinity. Okay. The third one is the ART tax slab. How will you know what is ART? Because this note is again slide 29. So it is here slide 29. ART is additional rate tax. Is this clear? Yeah? Okay. 5-minute break. Okay, where were we? Yeah, so we were talking about the additional. So I was just clarifying these terms. So we have something called the term called the slab. A slab by definition requires two numbers. In between the numbers is the slab. Okay, so the first slab is here. Maybe it's here, yeah. This is the first slab, this is the second slab, this is the third slab. Okay, so we call that a slab. Now there is also something called a threshold. The threshold has only one number. So this is the BRT threshold is 37.7. Okay, so we can call it the BRT threshold. Okay, now let me just write this one. I'll just write one and then you have to understand the rest. Okay. So is the BRT slab. Okay, 0 to 37 is the slab. The threshold has only one number. A slab has two numbers and a range in between. Okay, now whoops. Okay, 37.7 is the BRT threshold. So sometimes we will, I don't remember whether threshold has to, I think it has only one H. Okay, so BRT threshold. Okay. Yeah, so there's a difference between a slab and a threshold. The slab has two numbers and the part in between is the slab, and one number can be infinity because we are defining the over 125K, roughly 125, 140 is the additional rate tax slab, ART slab over that. Okay, so that's that the upper limit is infinity, so that's okay. And then this is called a threshold. One number, the upper limit is called the threshold. Okay, so we can call it, so we'll refer to it sometimes. So that has only one word. Now here there's another term we need to understand, which is called tax reducers. Okay, So what is a tax reducer? This actually requires more discussion, but I'm not going to spend too much time on it. I'm not spending time on this because actually I'll just briefly mention it, okay? Which is that the term that they use in the UK is slightly non-standard. They call it a tax reducer. Internationally, what you would call this is the concept of a tax credit. Okay, in most countries the language we use is tax credit. So what is the difference? One important concept that is here, not really part of your syllabus, but very important for you to know. Most of the things that I teach you which are outside your syllabus are so basic that it's important for you to know it anyway. So you should remember it even if it's not part of your syllabus. So tax credit versus tax deduction. One important, you must remember that in the UK, tax credits are referred to as tax reducers, all right? So the general distinction is tax credit versus tax deduction. So what is happening in the case of a tax credit, you can understand it here, okay? That is here. A tax credit is, so you find out the income tax due. You see this? What they're doing at this step, this is actually continued from the previous slide. Okay, so it's only one slide actually. So, in the field you have this computation of income tax due. Income tax due means we are calculating your income tax liability. Okay, that's another thing that we should remember from the law and from tax as well. The word liability. Liability means that you have to pay or do something. Okay, you have a legal obligation to do or pay something. So you first calculate your income tax. Okay, at one stage you calculate your income tax liability. So this plus this plus this, you get some number. Okay, whatever it is, 150,000 or something like that. Then you apply the tax reducers. Okay, less the tax reducer. Tax reducer is a UK term for a Turk's tax credit. So here you understand the concept of a tax credit. What does it do? A tax credit reduces your tax liability after it has been computed. Okay? So after the tax liability, after it here is referring to the tax liability. So I'll make it very clear so that there's no confusion. A computer would insist on this kind of clarification, although it's pretty clear it's already clear. It here is referring to the tax liability. Okay, so the tax credit reduces your tax liability after the tax liability is calculated. Okay, so whatever is your tax, you can think of this as some kind of a gross tax liability. After applying the tax credit, you get the net tax liability, okay, which is what you actually have to pay. Right, now what's the distinction? What's the distinction between this and a tax deduction? A tax deduction is a deduction that is reduced at an earlier stage. So the tax deduction comes at an earlier stage. Why? Because see, what is a tax deduction here? Let's say this one is the personal allowance is a tax deduction. Because a tax deduction is a deduction allowed in the process of computing your taxable income. Okay, so how do we get your tax liability? We get your taxable income first. We get your taxable income first, and then based on the slabs, we apply the tax rates on your taxable income. Do you understand? So the calculation of taxable income happens at an earlier stage. Once the taxable income is calculated, then the tax rates are applied on the taxable income to arrive at the tax liability. Okay, so you calculate the taxable income, then you calculate the tax liability, and then on the tax liability you apply the tax credit or the tax reducer at a lower stage, at a later stage. Is this clear? Right? So basically you can clarify it also by saying we can have another type of distinction, which is later stage, okay, of calc, okay. And in the case of a tax deduction, it happens at an earlier stage, okay. That is, how do we, in fact, we can give further evidence, further, by applying tax rates to taxable income. All right. How do we calculate the? Yeah. Okay. Tax liability is calculated. Um, we'll make it more clear, okay? We'll make it more clear that how do we get the tax liability number? How do we get the tax liability number? I put a full stop here and clarify this. How do we calculate the tax liability? We calculate the tax liability by applying the tax rates to the taxable income, okay? And what does it do? It reduces the tax liability after it or the tax liability has been calculated. I've already explained it actually, but okay, this is an over explanation actually, but anyway, still, after the tax liability has been calculated by applying tax rates to taxable income. So this is an over explanation. It's not really required, but I'm keeping it here because it doesn't hurt to have it, okay? So we know clearly, so this is what I mean by this is happening at a later stage. The tax credit part is happening at a later stage, and this is happening at an earlier stage of the calculation, okay? I'm spending too much time on this, but these are important concepts, so you should be clear about it, because there's no exam question coming on the difference between tax deduction and tax liability. So that's why I say that I'm spending too much time on it, but as a concept it's important. Okay, the later stage of the calculation, this is not the later stage, sorry, this is the earlier stage. So I have to clarify this. Okay, is this clear? So tax deduction happens at an earlier stage of the calculation. Is the deduction allowed to reduce total income in the process of calculating the taxable income? Is this clear? So taxable income calculation happens earlier. At that stage, you get to apply the tax deductions in order to arrive at the taxable income. After that, once the tax liability is calculated by applying the tax rates to the taxable income, then the tax liability is further reduced by applying the tax credits or the tax reducers. Is this clear? Okay, so if you see the slide 28 and 29 as one slide, you will be able to see the slide, what I mean by the, you'll be able to see what I mean by earlier stage and later stage. Personal allowance is a tax deduction, okay? So it is coming at an earlier stage in the process of calculating the taxable income. On the taxable income, you apply the tax rates and you arrive at the tax liability. This is your gross tax liability. Then you apply the tax credits, also called tax reducers. It's called tax reducers in the UK. And then you arrive at a net tax liability. Is this clear? So the tax credit gets applied at a later stage. That's an important distinction to know conceptually as a student of tax, okay? Here, I've already clarified this again multiple times, all right? Okay, this is important because, why is this important? Because sometimes you'll get questions where there are some tax reducers, okay? There is a tax reducer of some, there will be certain types of concessions which are given as a tax reducers, right? Like for instance, a mortgage interest payment on a rental property. If you own a I will come to this rule actually. The mortgage interest payment on a rental property is not given as a tax deduction, it's given as a tax reducer. So we'll see that when we come to property income. Okay, so important concept we have already covered. Okay, so tax reducer, so now you know what is tax reducer, you get tax bond. Okay, so these are obviously important. I'm not listing it as an important memorized slide because this is so obvious that, you know, I'm giving the memorized slide number only where there are some dates and stuff involved. Okay, so this one is pretty obvious, and these rates you don't have to memorize because it's in the tax tables, right? So but these concepts are very important. If I'm writing about it, that means you should know it. Okay, if I'm writing about it in the notes, you should know about it. Some general rules on married couples, etc. These also you have to know actually. You don't need to memorize this really, but you should just know that married couples are taxed independently. Because so this is part of your general reading, okay? Because sometimes you might get questions talking about a wife's income, and then they'll mention something about the husband's income. So those are taxed independently, so that doesn't really matter. Okay. So rates of income tax, we already know the rates. We don't need to worry about this. It's already in the tax tables. Okay. So these are called non-saving income, non-savings income, and savings income. There's a different types of income, but savings income is also taxed. Basically, if you have a very high level of savings income, there are some different rules for savings income. That's why they have discussed non-saving income separately. So you can see what non-savings income is. Okay. Now here's this important concept of grossing up. This is an important concept. 32. Let me see if I have a note against 32. Okay, somewhere I would have. Why have I not given a note against 32? Okay, so I should have given a note against. So I want to give a note on grossing up. Okay, I'm sure I have a note later on, but grossing up, you can see. So I'll just point you to this. I think it's an important concept actually. Here, okay, grossing up needs to be done. So we have come to grossing up. Okay. Now what we'll do is. So we have some important, okay, so grossing up is very important. You will know it. I don't think I need to mention it separately like this. So it's, let's go here, okay. Grossing up is done like this, okay. So what is the rule that they're mentioning here? That there is a calculation of grossing up that you have to do. So if you have any income received net of 20% tax, okay, this has to be grossed up in the income tax calculation by multiplying this by this, okay. So which is what we are doing. Certain types of income or income or payment, etc., they have to be grossed up. So grossing up is done by this, because the grossing up means that first it has been paid or received net, okay. So in that case, net the tax rate that they apply on that is 20%. So that's why when we gross up, we do it like this. We multiply the amount by 100 by 80. Okay, so this is what I've done here. This is a grossing up calculation. If we are doing any calculations, we need to know the gross amount. So if I enter like 600 here, this will do the grossing up for us. This becomes 6,750. Or this is basically nothing but divided by 0.8. Okay, which is the same as multiply by 100 by 80. Okay, so this gives you the gross figure. So this is a grossing up calculation which we have to do, which so this slide only warns you about this grossing up calculation. Okay. Now, so savings income has a different type of treatment, that if you have no other type of income, if you have no non-savings income, okay, so savings income we already defined, okay, so everything else is kind of non-savings income. And so if you have no non-savings income, and let's say you have basically 6,000 worth of savings income, okay, if you have 6,000 worth of savings income, you won't have any tax, because the savings income because there's no non-savings income. So what we do is first you'll see that when you look at the income tax pro forma calculation, it's not given here yet. When you look at the income tax pro forma calculation, you'll find that there is a separate column for non-savings income, and then there's a separate column for savings income, and a separate column for dividend income, right? So dividend income is again considered separately. So it's the terminology, as I told you, in the UK is very poorly constructed. Because strictly speaking, if you are calling something non-savings income, then dividend income should go straight into non-savings income, because it's a type of income which is not savings income, and anything which is not savings income should go into non-savings. But they have created a separate category for dividend income. So they have the categories are non-savings income, savings income, and then dividend income. So that's how they tax it. Okay, so let me put it this way. Okay, so let me just do it this way. At this slide itself, slide number 33, let me explain this point. It's a very peculiar thing about the UK income tax, the way they calculate it. Let me put it here itself. You should be aware of this, and I'll explain it to you already. Okay, slide number 33. Okay, so let's talk about the sequence of applying tax rates to types of income. Okay, or types of income, let's say, is, okay, let's look at a general income tax pro forma, since we have it. Okay, layout. Okay, let's look at this. It makes it easier to understand. Yeah, see, this is what we mean. All right, so let me just clarify this a little bit. Okay, this is critically clear. Okay, and I can actually clarify this as well. Yeah, see, this is your income tax, pro forma, income tax calculation pro forma. So please make sure you follow this system. Okay, this becomes taxable income less personal allowance. Remember that they have not shown the tax reliefs, etc. But this is your net income less the taxable less the PA becomes the taxable income. Okay, so here, so if you see, we can actually take this from here. We went up few slides. You see the definition here. So less tax relief, then net income less PA becomes taxable income. So we can already call this the net income, NI. Okay, and then less PA becomes TI. All right, now let me just go back to this one. This one, slide number 33. I want to mention one thing here. This is very important to understand, because again, the language in the UK tax system is very bad, actually. It creates a lot of confusion. Okay, types of income, we will just talk about the pro forma. We have the pro forma. So, 1 minute, let me just have that. Okay, here, you see the pro forma, it will be like this: non-savings income, savings income, and dividends income, if you can, and dividend income, actually. Okay, again, no need to open it in the class, because you can open it later when you have when you're at home. Okay, so now you see, so what happens is, so this format, once you get used to this format, then you'll remember the sequence is non-savings, savings, and dividends. Okay, so what happens is, what they're saying is, so what I was trying to talk about is that, let's say, types of income. Let me just take this thing here and oops, yeah, let me just put this thing here. Okay, types of income, pro forma computation. Okay, now let me sequence of, this is important to understand. Okay, sequence of applying tax rates to types of income. Okay, what is the sequence in the UK? NSI, SI, and DI. All right, this is the sequence in which you apply. What is the language I've used? Applying tax rates to types of income. Okay, so that means you will take the type of income. How much did you make in non-saving NSI? How much did you make in NSI? Let's apply the tax rate that is relevant. Okay, based on, how will we find out the tax rate that is relevant? What is the amount of income? Then we will apply the tax rate. Okay, so the sequence of applying is first NSI, then SI, and then DI. Okay, Now, you will find now, the reason it's confusing is because, how do I draw, I think the best way to do it is to do it on the thing here, okay? That is, let's just draw so if you have a cake, right? If you have a wedding cake or something like that, there's no, there's no ink here. Are these the ones that we're supposed to use? Or this is for that other one, right? I think this is for this one. Is that correct? So I shouldn't use this one here. I am so low tech on these matters. Okay. So yeah, we got this one, okay? So you have a bigger one here. That's like a wedding cake, right? That's it? Okay, so now what happens is that actually, so this is your NSI, okay? This is your SI, and this is the DI, all right? So you'll find often that in the textbooks and all, they refer to the dividends as the top slice, okay? So the dividend income is taxed last, okay? But actually what is happening is that when you have NSI, okay, you already eat up, so if your certain income is assessed to tax at NSI, as NSI, then you have already traveled up the slab. So you have these other slabs, right? So you have this 37.7 and the 125 and all that. So as you get taxed, so they refer to dividends as the top slice, okay, of income, which is because the dividend income is taxed last, okay, and then they will apply these. So they will, what they will do is they will, where is that tax table? Yeah. So when we start with NSI, and let's say you have 35,000 of NSI, not 35. Let's say you have 45,000 of NSI. So the first 37.7 of NSI gets taxed at 20%, and then the 45 and minus the 37.7 will get taxed at 40. Okay. Now, when the SI comes next, when you're taxing the SI for on that next, okay, then you will get your savings. There is a personal savings allowance PSA, okay, which we will discuss. So you will get that depending on the rates. Okay, so we have some rules on that as well, which I've done here. Let's say, see, if you had 24,000 of taxable income, you will get the full 1,000 of PSA. We'll see this rule, and I will mention it to you as something to be memorized. But what I'm trying to show you is that, okay, let's say this guy has, in this case, we are already more than that, right? So, and then the rule is, so this guy's already gone to 24,000. So if he has, let's say he has like 45K of, let's take this example where he has 45K of NSI, okay, and we can't write it here. So let's say the NSI is 45K and the SI is say 7K and the DI is say 3K, let's say, okay. So let's take this example. So what happens is the moment you have 45K, you have already moved into the first 37.7 gets taxed at 20. Now then the balance gets taxed at 40. So you have already moved into the 40% slab. So you have to remember these things, okay? So what will happen now is they will see what's your total taxable income. In this case, it's coming out to 55, okay? So 55 taxable income is in the second slab. It's the second slab, okay? So if it's the second slab, then the rule for PSA is, if in this case we'll enter the, you'll see this rule later on. I'm just showing you how to do the calculation. So your taxable income is 55, which means under the rules you'll get a PSA of 500, okay? So what will happen here is, now this thing has already gone into the second slab, all right? The second slab is actually I have not drawn the slabs there. The savings income is already in the second slab. So you have 7K of savings income, but you have 500 of PSA, okay? So 7 minus 7K minus 500 is 6.5K. So are you following me so far? Are you following? Yes, everybody? Is everybody following basic calculation? I'm sure it's not, I have not drawn it very well, but let's put it this way. Let's go here and do it like this, okay? So this you don't have to worry about. This rule you have not been taught yet, but I'm telling you that if your taxable income is 55. So we took an example of a guy. We saw this for pro forma, right? We saw this pro forma, right? You know, there's nothing to explain here. This is the rule. You have to write it like this, okay? This is the rule. So they have three categories of income: NSI, SI, and dividend income, okay? So all this goes into NSI, you see? Employment, property income, okay? Etc. All this stuff goes into NSI, okay? They have given the list also. So now, my point is that they will refer to dividend as the top slice of income. The reason it's called the top slice is because they will tax it last, okay? Now, so the point you have to understand is, the point you have to remember is that as you get taxed, as your income is being assessed to tax, okay, and what is the sequence in which they will assess it to tax? They will take the NSI first, then they'll take the SI, and then they'll take the DI, okay? So as your income is being assessed to tax, okay, so let's take this example of a guy who has 45K of NSI, and 7K of SI, and 3K of DI. So his total is 55, okay? So his total income is 55. That's where I have this from, okay? That's from where I get this 55K. Okay, so this guy's total income is 55K. Okay, so therefore I enter it into this. Once you know the rule, you can also do this spreadsheet. It's a very simple thing. I've just given a if-then calculation here. Here, you see? These things also you should know how to do. Okay, that is, you first understand the logic of the rule, and then you program it into a spreadsheet. This is also a type of programming. We are just using, these are in programming, there is something called a subroutine. Okay, subroutine means these formulae that we are using from Excel, these are just like standardized subroutines. So I'm just, by using the IFS formula, I'm just calling a standardized subroutine and then applying it. Okay, a subroutine is just like it's like a subtask. Like if you're making a cake, okay, one subtask will be open the packet of butter and put the butter into the bowl. Okay, so that's a subtask. You just say, okay, butter subtask, and then the robot will take the butter, open the packet, put it into the bowl. Okay, so it's just a subtask. So it's not very complicated. So anyway, the point is this. So let's go back to our example. I just moved to Excel, emphasizing Excel once again. So this guy has 55K of income. Okay. So under the rules on personal savings allowance, if your taxable income is over 37.7 but under 125, that means if it is between the first two slabs, if it's in the second slab, if your TI is in the first slab, your PSA will be 1K. If your TI, remember we're talking about TI, your TI is in the second slab, your PSA is 500. Okay? And if your TI is in the third slab, your PSA is 0. Okay? These are the rules. So in this case, so you can see here, if I make 176K income, my PSA goes to 0. Okay, so the spreadsheet has been programmed correctly. Okay, so we go back to our example of 55. This guy, I just wanted to show you one important thing in how we are going to tax the income and how you start creeping up. You have to understand you're creeping up the brackets. Okay, you're creeping up through the income tax brackets. As your income is being assessed to tax, you are creeping up through the income tax brackets. You must not lose sight of that. Okay. So, what is the sequence of assessing different types of income to tax under the UK rules? First NSI, then SI, then DI. That's why DI is called the top slice of income, okay? Because it's being assessed last, okay? So, the point is, in this example, so if the guy has, now see again somebody has opened it, don't open it, remove this, because in the classroom it's distracting for me to have this thing here. You open it later when you're at home. Whoever's opened it should close it. When you're at home, this is meant to, this is shared with you so that you can practice at home. Okay, so 45K of NSI, that means that the first 37.7K will get taxed at 20%, and then the 45K minus the 37.7 will get taxed at 40%. Is this clear to everyone? Are you following me? Everyone should follow this simple calculation. Everybody, okay, including people on the last bench who are doing their own things. Please make sure you follow this. These are important things. Okay, are you following here so far? Okay, on the 45K, you have 45K of NSI. So on the first 37.7K, you have to pay 20%. Yeah? And on the balance of 45 minus 37.7, you have to pay, what did I say initially? First you pay 20% on the first slab. Second slab, 45 minus 37.7, you pay 40%. Okay? You pay 40%. Now, what you have to remember is now you have already moved into the 40% slab. Okay? So now, because you have to remember your TI. Your TI is 55. Okay? These three together, 55. Your TI is 55. So therefore, 1 minute. Sorry. I made a mistake here. It's not really TI. It is TI actually. That's okay. Because I got confused between the PA and for a moment I got confused. PA is different from PSA, okay? PA is different from, that's why I got confused. PA is around 12,000 something, okay? This is called PA, so I got confused. Okay, you can get confused easily because one is PA and one is PSA, okay? PA is personal allowance and PSA is personal savings allowance. They are two different things, okay? Two different things. So PSA, we are talking about PSA and it is a function of TI. That's why it's important to be also clear about the NI and the TI. So that's a function of TI, okay? So it's a function of TI, and if your TI is 55, your PSA, that means your TI is in the second slab, so your PSA will be only 500. So your PSA is only 500, okay? So in this case, now, when we have to tax the SI, we get only when your income is already, when you have other types of income, you have only the PSA to be applied. So your taxable as savings income, your taxable income is 7, but you get a PSA on that, which is 500. So on the 6.5, you will have to pay 40%. Is this clear? On the savings income, you're already in the 40% bracket, so you get only a 500 PSA. So on the 7K of savings income, you have to take out 500, and then you have to, on the 6.5K, you have to pay 40%. Is that clear? You have to pay 40% because your NSI of 45K already pushed you into the second slab. Is this clear? It's already pushed you into the second slab. So when you take the next category of income of SI, you have to remember that you're already in the second slab. Okay, so after deducting your PSA, whatever it is, whatever the applicable PSA is, in this case it's 500 because your TI is 55, so the PSA according to the rule is 500. Okay, now then on the 6.5 you're going to pay 40%. Is that clear? Okay, because you're already there. Now, next comes the dividend income. Okay, so this dividend income is called the top slice. Okay, so the dividend income will become considered next, and there is a dividend allowance of 1K, if I'm not mistaken. We'll see what the allowance is. Okay, so dividend allowance is 1K. It used to be 1K last year, so unless they have changed it this year. So we'll see what when we come to the dividend slide, we'll come to the dividend income. At the moment, we'll assume it's 1K. There's a dividend allowance also. So where is my, here. So then, now we have a dividend of 3K, dividend income of 3K, and there is a 1K of dividend allowance, just like personal savings allowance. There's a dividend allowance of 1K, that means you can deduct it, okay? It's a deduction, it's a tax deduction. PSA is a tax deduction, okay? So these are all tax deductions. And so basically you have on the savings income of 6.5, you will pay 40%, and on the dividend income also. Now remember one more thing, how much, you have to keep a running total of how much income has been assessed to tax, because you have to remember when you are going over from the second slab into the third slab, if you are going over, okay? So as you are assessing income to tax, you have to keep a running total of, a cumulative total of how much income has been assessed to tax. Because when, let's say, if you have really high income, okay, once you start assessing the income, you are moving, as you are assessing income, you are moving through the slabs. So you have to keep a running total of how much income has been assessed to tax. What I mean by that is this, that at this point, when we finish assessing the savings income and charging 40% tax on 6.5K, we have a running total of 52K of income. In the Excel, it is normally given here. I don't know why it's not showing the total. Maybe something. Anyway, it doesn't matter. In the Google Sheets, it will normally show it. But anyway, so 45 plus 7, okay? So we have assessed 45 plus 7 of K of income. So we have assessed a total of 52K of income to tax. Is this clear? Are you following? So that means we are still here. We have assessed 52K of income. We are still in the second slab. Okay. Now, if I had, let's say, for example, just for the sake of argument, if my dividend income was, let's say, 95K. Let's say my dividend income was 95K. Then, first of all, my TI already exceeds, and then my PSA would have gone to zero, but that's not the point. I'm now trying to show you the income, the running total. Here is 45. Here is 45. Here is 52. Okay? 45 plus 7 is 52. The part that is taken out as an allowance is not really allowed to deduct the total income assessed to tax. Okay? In the sense that this is not, it is actually 52 full. It is not 51.5. Do you understand? This one, because you took a 500 personal allowance, a personal savings allowance, the total income assessed to tax is not 51.5, it is still 52. Do you understand? So let's understand this also, and let's be clear that when you are assessing 45K of NSI to tax, fine, there's no allowance on that. Okay, you got a personal allowance earlier, that's fine. But then you move into savings income and you've got 7K of savings income, but you have 500 of 0.5K of personal savings allowance. Okay, but when you are calculating the figure of how much income has been assessed to tax for the purposes of checking whether you are moving from this bracket to this bracket, okay, whether you have to keep a check, are you moving from this bracket to this? This is a function of the income that is being assessed to tax. So for that purpose, when we look at this savings income of 7K, okay, and we know that 0.5K has been given as a personal savings allowance, for the purpose of calculating how much income has been assessed to tax, we will not consider that PSA amount. We will still say that the total income assessed to tax is 52, not 51.5. Do you understand? Is this clear? Okay. So now you have 52K of income that has been assessed to tax. That means you are in this second slab. Okay. Now let's say in this case what will happen is, let's take the earlier case where he had, I don't know what the income I gave. Okay, so we will forget it. Let's take the case of 95K dividend income. Okay, in that case the taxable income is 147. Okay, so this will become zero actually. So now we are mixing examples because I'm trying to show two different things. Okay, so now let's take the case of 95K dividend income. What will happen when you have 95K dividend income? Now, your total income assessed to tax, running total, cumulative total, is already 52. What is you have to be watching out for this higher rate threshold, 125, 140. Okay, because the moment you go into the ART slab, your tax rate becomes 45. Okay, so you have to keep an eye on that total income that is being assessed to tax. So if you have 95K of dividend income, you have to really see here how much is, say the 125, you have to do a calculation of 125, 140 minus 52. You understand? Minus 52. Sorry, not 124, but 125. 52,000. Okay, so let me just do it as like this, 125.140. Okay, so 125.140 minus 52. Is this clear? Okay, why am I doing 125.140 minus 52? Because this is not required. Why am I doing this calculation? Because the HRT threshold is 125.14 in thousands, counting in thousands. It's 125.14 is the HRT threshold. The moment I cross the HRT threshold, my tax rate goes to 45. Okay, so that's why I have to keep an eye off on this this difference, because I have. And why is it minus 52? You see, why is it minus 52? Because 52K of income has already been assessed to tax so far. So in terms of climbing through the threshold, okay, so you can think about this as you are, although it's given from bottom to top, but we normally start climbing from the bottom, right? So we should write the tax rates like this. The 0 to 37 is at the bottom, and 37 to 125 is at second floor, and third floor is 125.14 plus. Okay, that's how we should write it, but it's normally written like, it is written like this. The point is, as I'm climbing through the floor, as I'm climbing through the floors, I have climbed through the first slab. Okay, I have already gone on to 52K of assessed income, right? Now I have to remember how much space I have left before I cross into the third floor or the highest slab. Is this clear? That's why I have to see how much assessable income I have in terms of how much room do I have before I cross into the third floor. So that's why I have to do this calculation. This 125.14 minus 52. Is everyone clear why I did the 52 calculation? Yes, you understand? Everyone? Some faces, if I see any face which is not clear, which doesn't have a clear, has everyone understood why I did this? Yes? Okay. And so anyway, I'm just going to explain it once again. Okay. What we are trying to do is make sure that we keep a track. Let me try to do it here again. But we can do this over here actually. We can do it over here. I can keep a slab, okay, here, and we can have different colors, okay. So here we can have BRT, no, BRT slab, okay, so we can call it the BRT slab. BRT slab, I'm calling it BRTS, okay. This is HRTS, HRT slab. I'm not writing slab. ARTS with the upper limit of infinity, okay. I'm not writing the numbers because you know what the numbers are, okay. So BRT is 137. Here, these are also given over here, okay. BRT is 37.7, HRT is 125, 140, and above that we go into the this HRT means higher rate tax threshold actually. This is actually should be called the BRTT. Basic rate tax threshold and the higher rate tax threshold. This is the higher rate tax threshold. We know this, okay? So as we have this, let's have, maybe we can have some nice colors. We can have some nice colors like this. Maybe we can have a yellow here, and we have a green here. Let's have a blue here, and and we can have maybe some kind of, what can we have? let's have a green here. Okay. Now, what I'm trying to do is, let me explain it once again. So this is your slab. These are your 3 slabs, okay, which you can see over here. These are the same things. But I flipped it around. This one is, 20% slab down to 45% slab. But I have flipped it around here. Now this is the 20% slab. And this is the 40% slab. And this is the 45% slab. Is this clear? Okay, I have flipped it around because that's how we are going to assess the income. Okay, so then first we apply the NSI here, and we already saw 45K of NSI, but up to 37 got assessed at this. So this is why I need to keep track of how much, as I'm assessing income to tax, following the sequence given over here. First this, then this, then this. Okay, as I'm assessing the income to tax, I am already moving through the slabs. I'm going like climbing through the floors. You can think of these as 3 floors. I'm climbing through first floor to second floor, third floor, so on and so forth. So, and this is a function of, my climbing is a function of how much income is being assessed to tax. Okay, so first I assess 45K of NSI, so I already move into the second floor. Now I have to assess 7K of SI, okay, even though I got a 0.5K deduction because of the PSA, I still don't count that deduction for this purpose. So I still count myself as having assessed 52K, not 51.5K, okay, of total income. So at 52K of income assessed to tax, I'm on the second floor. Okay, now I have to see, because I already know I have a high number of dividend income. So I'm already going to cross the 125, 140. So first I have to see how much room I have. Where's the 73 coming from? The 73 is coming from 125.14, which is this one by 1,000. This one divided by 1,000, okay? This divided by 1,000 minus 52K. That is 52, all right? Is this clear? Why do I need this number? Because I need to see how much room from where I am on the second floor, how much more income can be assessed to tax before I cross into the third floor. Is this clear now? Yeah? Of course, it's being recorded, so you can play it back and but I forgot that actually. I'm explaining it again, but it's all recorded. So actually, we don't really have the luxury because we have so much to cover. I really can't afford to explain it multiple times. You have to play back the recording. Okay, right. But this is important, so let's do it first. So I need to be aware of this 73 number, because after assessing 73K more of income, I will now cross into the third floor. Is this clear? That means I will be taxed at 45%. Okay, so which means what will happen here is that on that 95K of dividend income, I will first take a 1,000 dividend allowance, okay, which doesn't affect my total of income being assessed to tax. Okay, so it's still the full 95K, not 94K. So therefore, I still need to worry about 73K. I don't have 74K to play with. Just because I have a dividend allowance of 1K, okay, as I said, those allowances will not count for this calculation, which is the total income being assessed to tax. Those allowances that you get, savings allowance, PSA, dividend allowance, those will not be counted. You will get the allowance for the calculation of the rate, total tax liability, okay? In the sense, see, let me explain this here, okay? See, you have 95K, now you already have 52K assessed to tax, okay? Let me explain even the 52K here properly, okay? So you have what? Why 52? Because 45 plus 7 of SI. So now this is actually not correct 500 because your TI is already 147. So your PSA is actually 0. But I'm mixing up two examples and showing you a PSA of 500 because I want to show the distinction between the allowance being given to you for the purposes of calculating your tax liability. The allowance will be given to you for the purposes of calculating your tax liability, which means that the 40%, you're already in the on the second floor, okay? You're already on the second floor, so the 40% tax on savings income will be applied on, not on 7K, but on 6.5K. You understand? When we do an actual calculation, you'll see it. Right now, I'm just walking you through the steps. So let's look at the savings income. What is the meaning of this? That you do get the benefit. Ignore this because we are assuming TI is 55, not 147. I'm mixing up two examples. Okay, when you get a PSA of 500, okay, and your savings income is 7K, how do you get the benefit of the PSA? Now remember, you're already on the second floor, so your tax rate is 40%. Okay, so your income tax on liability on savings income is going to be 0.40, okay, 40%, 0.4 into, let me write it this way, 7 minus 0.5. Do you understand? Oops, this is what I mean. How do you get the benefit of the 500K PSA on the 7K of savings income? You get the benefit because the 40% tax rate, which applies to you because you're already on the second floor, okay, based on the amount of NSI you had, and the amount of NSI already took you into the second floor. That 40% tax rate will be applied not on your total 7K of SI, but on your 7K minus the 0.5K of the PS, personal savings allowance. Is this clear? That's the meaning of the allowance. Okay, so the tax liability will be calculated as 40% times 7K minus 0.5K. Is this clear? Yeah? Okay. Now, so this is fine. That's your tax liability. Okay, here. We can also calculate this. On the 45, what is your, let's quickly do a random tax calculation here so that we can already get a full understanding. On the 45K, how much tax do you pay? On the 45K, you pay, what do you pay? 0.2 times, we'll just put it in brackets to make it, you don't need to put it in bracket. 0.2 times 37,700. Is this clear? Because on the first floor, you pay 20% tax. On the first floor, you're paying 20% tax. So on the NSI of 45K, you are paying total tax of 0.2 into 37.7 plus you will pay on the difference between 45 and 37.7. So on 45, I think I'm mixing up my thousands and everything. Yeah, I'm mixing up here. I put it in thousands. Okay, so here I have to put it in thousands. Okay, so not 37,700 but 37.7. Okay, right? We're doing it in thousands plus. Okay, now what is the plus? Now I'm paying 0.4 into, I have to see the difference between 45K and 37.7, right? So 45 minus 37.7. Okay, that's going to be my tax liability on the non-savings income. Does everyone agree with this? My tax liability on the non-savings income is the 20% rate for the first floor, for the BRT slab, yeah, okay, that is up to 37.7, and then the next floor the rate is, then on the next slab the rate is 40%. So what is the amount of NSI in the next slab, which is 45 minus 37.7. Is this clear? Okay, on that I have to pay 40%. Okay, so it's clear now. Why is it giving this kind of thing? 0.2 into 37. I didn't give this here, but I don't know why do I want to give it. Yeah, okay, now it's okay. 10.46. It's actually 10. Okay, so we can have everything here as we don't need 3. Let's have 2. Okay, so on this I have a tax liability of 10.46. On this I have a tax liability of 2.6. How did I get 2.6? Because I do have I'm assuming we have a savings allowance. Actually, for 147K of TI, you won't have a but let's assume for this example that you have, because I want to show you how it applies. So the 40% is going to be applied on the savings income because you're already in the second floor. Then it will be applied not on 7K but on 7K minus 0.5K because that is your PSA. Is this clear? Okay. But the point is this number, which is, I didn't give a proper title here. Okay, I should, should give a proper title. What do I need here? Increase. Yeah. So this one, this column is actually the income assessed to tax. I'm keeping a running total. It's a cumulative total of the income assessed to tax. This number is not going to be this. This is 52. Why is it 52? Because it is basically 45. What happened here? Why is not something wrong here? (45 plus 7). It is not 45 plus 6.5. You understand? This is 7. This is 7. This is, let's keep it here. Let's also increase the limit here. Okay, yeah. So this, what I'm trying to say is that this income assessed to tax, the point I was trying to make is that you have to keep a running total of the income that has been assessed to tax. Do you understand what it is? What is the meaning of this statement? The income that has been assessed to tax. That is, when I have considered the income, applied the appropriate rate of tax, and figured out the tax liability. That's what I've done so far. So far these incomes have been assessed to tax. Is this clear? The language is a little complicated, but you're going to be an accountant. You need to have very good command of English. Okay? So you need to understand these terms. So in the income that is assessed to tax, I am going to write the 45 plus the 7. I am not going to write the 45 plus 7 minus 0.5. Do you understand? The 0.5 will not be calculated in the income assessed to tax. Is this clear? Okay. So this will remain as 0.7 to be added. Okay, so that is now 52. Is this clear? 52 is assessed to tax. I need this number 73. Why do I need the 73? Because I have 95K of dividend income. Out of that, I need to know how much is, I've already got 52K assessed to tax. If I assess 73K more of income, I will already cross into the higher rate threshold. Then my rate will be 45%. So I need to know how much more of my dividend income can be taxed at 40%. Okay, so for that I need this number, 125.14 minus 52. Is this clear? This is the higher rate threshold, 125, 140. So this is in thousands. Is this clear so far? Okay, so that's my 73. So now my dividend income will be, what is the tax on my dividend income? Okay, now I'm telling you that there is a dividend allowance of 1,000. We'll see if it has changed. Okay, there's a dividend allowance of 1,000. So first thing I can do is I can take, so 95K, I can take out the dividend allowance. Okay, so I can make it as, but how do I, okay, well, how do I take out the dividend allowance? So first I take out 94. Okay, so let me just do this. The assessment number will be different. So, okay, the dividend assessed to tax, now we have to calculate this. Okay, so it's going to be, let's take out 94 first. Okay, so let's take out 95 minus, and how am I going to write this? Okay, so let's just do this without the dividend allowance. Let's assume there's no dividend allowance, then we'll do it later as a second step, because the calculation. Now I want to just show you the jumping between the floors, how to jump between the floors. Then we'll do that dividend allowance calculation later. Okay, so let's assume there's no dividend allowance. So I have 95K of dividend income, out of which 73 will go at this. Okay, so we'll have this one, the tax rate will be on dividend income will be 0.4 times on 40% on 73K plus This one will be 95, no, it's not written. 95 minus, how much have I already taxed? 73. Okay, plus 0.4 into this, and this one has to be 45, right? This has to be 0.45 times. Okay, is everyone clear? Let's assume there's no dividend allowance, okay? We'll come to that later. So just to understand how we are skipping between floors, okay? Based on the total income assessed to tax. Is everyone clear about this? So my total dividend income is 95K, there's no dividend allowance. So 40% will be taxed at 73 because already I'm at 52. Another 73 will take me beyond the 125, 140. Okay, so for 40% tax on my 73K of dividend income, then I cross into the third floor. And so on my total dividend income is 95, out of which 73 has already been taxed at this 40% rate. So the balance that remains to be taxed is 95 minus 73. Okay, is it clear? Yeah, everyone following? Many of you are not looking at what we are doing on the screen. I hope you guys are going to follow later on, because later on you're going to get into problems. Okay, don't spend your time, not in this subject. Maybe other subjects you can do it. This subject, if you don't pay attention in class, you're going to be in big trouble in the exam. This is very complicated in the sense the rules are very complicated. You need to spend the time in the class taking the advantage of my explanations. That takes you 50% of your work is already done. Then you just do the balance at home on your own. If you don't get the foundation in the class, you're going to be in big trouble later on. Okay, so 40% at 73, 45% at 95 minus 45% on 95 minus 73. Is this clear? Okay, so this is the point I wanted to emphasize here. All I wanted to emphasize, actually we broke the flow of the slides and all that, but I wanted to emphasize this important point that as you are assessing income to tax, you are moving through the slabs. Okay, so this is what is important. You're moving through the slabs, and so you have to remain conscious of that. So you have to remain, you have to maintain a cumulative total of the income that has been assessed to tax. Is this clear? This is your total over here. That it is 52 and it is not 51.5. Okay, although you got a 0.5. This is the tax is being calculated on the 51.5. Okay, the tax is calculated on the 51.5, but the income assessed to tax at the running total is going to show 52, not 51.5. Is this clear? That was my point about the personal allowances not being counted in the total income assessed to tax figure. Okay, the cumulative figure. Okay, is this clear? So now you have some basic pattern of how we are going to do the numbers. Okay, now it's just a matter of looking at the rules. And so I don't know why I got into this detailed thing. Yeah, I think it's very important actually that, yeah, I got into this in slide number 33. That's fine. Now we'll look at a special case, which generally does not come up, okay, which is if what they're talking about is that income tax on savings, these all have to be remembered. Let me, just to be on the safe side, let me also put this here as to be memorized, obviously, because it's pretty obvious. Normally we don't get questions on this, but you should be clear about that rule, okay? Now, what this means is that, see, because if it falls within the first 5,000 of taxable income, this rule, all it means is that if you have, okay, and then if we combine this with the, okay, the PSA, and if you combine these two, 34 and 35, okay, so basically what happens is this, what I did on the screen there, let me go to 34 plus. Okay, now we are talking about the personal savings allowance. I'm not going to memorize on this because it's quite obvious you have to memorize. But anyway, let me just put it here just to be on the safe side. Okay?
I think it's already
already?
At the end of the class.
Oh, I didn't put an alarm. Okay, 1 minute. I was just wondering why it's taking so long. What time are we supposed to finish? 3:25. Oh, okay. I didn't put an alarm. Okay. Okay, so we'll stop here. We'll stop here. We'll stop it as, say, let's say 300. We'll stop it at 33. No, we didn't even cover 33. So we'll do 32, okay? We finished at 32, okay. All right, okay.